and gentlemen, good day and welcome to Q4 and FY2024 earnings conference call of Yasho Industries Limited, organized by Orient Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Bhavya Shah from Orient Capital. Thank you, and over to you, Mr. Shah.
Good afternoon, everyone. Thanks for connecting to Yasho Industries Q4 and FY24 business Concall. Today we have with us from the management Mr. Parag Javeri, Managing Director and CEO, Mr. Yayesh Javeri, Whole-Time Director, and Mr. Deepak Kaku, CFO. Before we proceed with the call, I would like to give a small disclaimer that the conference call may contain forward-looking statements which are based on the beliefs, opinion, and expectation of the company as on today. A detailed disclaimer has been given in the company investor presentation. I hope everyone had a chance to go through it, which was uploaded on Stock Exchange yesterday. I would like to hand over the call to Mr. Parag Javeri. Over to you, sir.
Good afternoon, ladies and gentlemen. I extend a warm welcome on behalf of Yasho Industries Limited to all of you who have joined us for this results Concall. We appreciate your time and interest in our company's performance. I hope everyone had an opportunity to go through the financial results and investor presentation which have been uploaded on Stock Exchange and on our company's website. Also, we are quite glad that we have completed our Pakhajan project as per schedule and have commissioned it on 9th April 2024. We are quite excited about the same. Our consolidated revenue from operations is rupees 593 crore for the full year, which is a drop of 11.6% over the last year. However, we achieved volume growth by about 13%. Even amidst challenging macroeconomic conditions. A significant contribution has been our focus on improving the product mix and implementing dynamic pricing actions. Despite difficult operating environment, company has continued to maintain stable performance. Global demand is showing sign of stability and a bit of recovery. But we need to be cautious because of the geopolitical instability and high interest rate environment still continue. We expect sustainability to be a long-term trend. This year, industrial chemical contributed 84% of top line, whereas consumer business contributed 16%. We achieved 64% of our sales from exports and 36% from domestic business. The outlook for FY25 for both the market continue to be optimistic. In conclusion, we are optimistic about the trajectory of our business and excited about the future prospect of Yasho Industries Limited. Our commitment to creating a long-term value for our stakeholders, coupled with prudent financial management and strategic initiatives, will be instrumental in sustaining our growth in coming years. So that it's from my side. We will open the floor for Q&A. Thank you very much. Hello?
Yes, sir.
Yeah, we open for the question answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have our first question from the line of Arman from Blue Sky Capital. Please go ahead.
Yeah. Am I audible?
Yes.
Yeah. My first question is, are borrowings now combined long-term and short-term around 550 odd crore? Can you tell me what is the average cost of borrowing for us? That is my first question. And my second question is, in Q4, our volumes rose by 30% YOY, but our sales have not rose to that extent. That means there has been a lower realization. In spite that we have improved our margins. So will the realization what we have achieved in Q4, will that be similar in next year, or that new Pakhajan plant that in which we have already told about 20% or over 20% margins we are expecting, so margin will shift towards a bit of more upper side? Yeah, thank you.
Our cost of the fund is between 8.75% average cost for the borrowing. Second question of your revenue versus the volume growth. The last year there was a challenging time. All the raw material prices are down. So despite having a higher turnover, the selling prices was under pressure. So the revenue growth has declined. You have seen that we have grown on a yearly basis by 13% volume, but still has a degrowth of 11% in the top line. So that clearly shows that the selling prices are under pressure, and so does the raw material prices. And we expect that this to continue at least for next 6 months. We don't see a dramatic upward in the raw material prices, so does the finished goods prices, unless there is a disturbance once again.
Okay, so margins will be overall. What will be the guidance for the FY25, because our new plant has also been commenced production. So what will be the overall guidance for the margin for FY25?
We have said always that the Pakhajan will add up some additional top line margins improvement, and we expect that in FY25 the margins should improve to anything between 19 to 20%, which from right now is about 17.8%, should improve to 19 to 20%, depending on that range.
Okay. Thanks a lot.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of Rahul Jain, a shareholder. Please go ahead.
Hello, sir. Am I audible?
Yes.
Yeah. Can you give the contribution in the industrial side of the three categories, basically rubber, lubricants, and specialty? What is the revenue contribution of these individual categories?
We don't have, sir. We don't provide that individual breakup. We can only give you the breakup of industrial and consumer. Some category we don't have, and we don't intend to give that information. I'm sorry.
Okay. So can you give a brief overview of the kind of product that will be produced from the new capacity? Are they new, completely new products, or it's something we already are into, something which the products which we have already?
We already have almost 75% of the product which is going to produce from Pakhajan are our old product which we are producing in Vapi. We moved to the Pakhajan purely because we need a higher volume. While there are 1 or 2 products which are new, which we have started at Pakhajan.
Okay. Thank you.
Thank you.
Thank you. We have our next participant from the line of Anupam Agarwal from Lucky Investments. Please go ahead.
Thank you for the opportunity. Good afternoon. Sir, my first question is on the answer that you just gave to the previous participant. Since we are moving, sir, 75-80% of our products which are already at Vapi to the new plant, why is it that realization and average selling price per kg is far lesser in the Pakhajan unit compared to the Vapi? Seem to have some disconnect there, so maybe you can make a comment.
Anupam, I'm sorry, I can't hear you anything. There's a lot of info coming from your
Just a moment, sir. Give me a second. Hello, am I audible now?
Yes.
Yeah. So my question is, since we are moving 75% of the products from Vapi to Pakhajan, at Vapi we do about
75%. I never said 25%. I said the Pakhajan of that 25% is the existing Vapi product. I didn't say the Vapi is 25% going to Pakhajan. So let me rephrase it. the whatever we are making in Pakhajan, of that 75% is the existing product of Vapi. Vapi is not moved to Pakhajan.
Exactly.
Exactly. Product is moved out.
So 75% of the products are existing products where we make a 500 rupees per kilo realization. And once we move to Pakhajan, why is there a disconnect in the average selling price from 500 to 350 is what we mentioned in the presentation? What is the disconnect there?
No. Still you are not getting here. We have moved only the few products which are already priced at the same price which is going to sell from the Pakhajan same price. So the products which have been moved to Pakhajan are kind of a high volume average price. They are not a high price product of Vapi.
Okay, and they are all industrial, right? Lube and additives.
Yes, lube and rubber and specialty.
So you were saying that the products that we are existing products that will go to Pakhajan are at a higher realization compared to Vapi or similar to Vapi at 500 rupees?
Again, you are stuck to 500. I don't know from where 500 has come. I'm just repeating our average selling price realization from Pakhajan will be in the range of 350 plus minus somewhere in that range. Products are also produced in Vapi of the same price, but Vapi was produced in a very small quantity compared to the Pakhajan. So the change will come in a volume.
Understood. Sir, in your opening remarks, you mentioned something about implementing dynamic pricing strategy. Can you elaborate a little more whether it is, pricing attractively to get more market share from the customers?
Absolutely. This is a time where we need to onboard many customers which are waiting for us to start the plant. We need to be a little aggressive. Right now, there is a lot of competition coming out from an overseas market. The couple of countries from Asia are selling or dumping products at a very low price. We need to be a little aggressive on that side to ensure that the plant starts operating at least a reasonable capacity, so the plant gets used to it.
Is that the reason, sir, we are guiding at 350 rupees?
No.
Because of the strategy that we are looking at?
No.
Okay. Understood.
Thank you.
Secondly, sir, my question on the debt again. What is going to be the debt repayment plan, going forward? We are at a 550 crore debt. How much, whether there is working capital included of the new plant in this, first of all, is the question. And going forward, what will be the peak debt in FY25?
I think this is a peak debt in FY25. We don't intend to borrow any further money. Our repayment is only starting from April 25 only, not before that. And we intend to bring down this EBITDA to debt ratio of 5.2 today to below 3, somewhere in that range, in FY25.
Understood. Thirdly, sir, you've time and again said that, in the first year of operation, you'll do about 50% of utilization of the new plant, and broadly 20-22% of EBITDA. If I just, hypothetically put a math there and post interest and depreciation, sir, we will be just breaking even at 9,000-10,000 tons of volumes. Is that a fair assumption?
Yes, roughly yes, that's true.
Okay, so the full benefit of the plant is only going to yield in FY26?
Yes, that's correct.
Okay, and what is the drawing board plan for the second phase of the expansion? I mean, have you thought about it?
We will discuss that in January 25.
In January 25, understood. Okay, sir. That's it from my side. I'll get back in the queue if I have any. Thank you.
Thank you, sir. We have our next question from the line of Radha from B&K Securities. Please go ahead.
Hi, sir. Thank you for the opportunity and congratulations on commissioning of the new plant. So, sir, I wanted to ask that as on date, what are the total number of SKUs that we have in rubber chemicals and the lubricants?
Sorry, can you come again?
What is the total number of SKUs that we offer in rubber chemicals as well as lubricants separately?
Number of products you are asking me. I think we are in the range of over 100 products into the rubber and lubricant segment. 100 products.
100 total. How much if you divide it between rubber and...
90-100 products in the rubber lubricant. Active.
Sorry, sir?
Active products are between 90 to 100 products in rubber and lubricant.
Okay. And so, actually, I wanted to ask how much in rubber and how much in lubricants?
I don't know right now off the hand, but should be in the range of about 60-40. 60 in rubber, 40 in lubricant.
All right, sir. Sir, out of these products, how much would you consider as a commodity and how much as a specialty product? Because in previous Concalls, you have mentioned that we are more into specialty. So just wanted to understand what is considered as...
90 to 100 product, about 25 to 30% is a specialty, rest are commodity.
Okay, sir. So secondly, in previous calls you have mentioned that Indian tire companies are our key customers. So also, like currently you mentioned that 20-25% is in specialty. So I wanted to understand with respect to rubber chemicals that we must be supplying to these tire companies. So, where does tire companies use commodity as compared to specialty rubber chemicals? As in, what is the value addition of a specialty rubber chemical as compared to a commodity for a tire company?
Well, tire company use very little specialty products. They use more for commodity. While non-tire industry, which is profile industries, industrial belting and other automobile products, rubber products are used as specialty more and less of the commodity.
Alright. So, thirdly, I was going through your previous con calls wherein it was mentioned that 50% of the rubber chemical revenue is from export. So export demand, as you highlighted in the opening remarks also, that it had remained subdued for the past few quarters. So can you please highlight any demand recovery being witnessed in the export? And if not, then by when, and what will be the, the drivers for the demand recovery in the exports market for us?
I just made a statement that global demand is showing sign of stability and bit of recovery. So it has, we have seen the lows, and now we think that the demand or the destocking and everything is over. People started buying the product. We see that could be one of the reasons why we saw the big jump in volume growth in the previous quarter.
So any regions you would like to specify which are the regions where we are seeing the demand coming in, whereas some regions where it is relatively low?
I think we are seeing a recovery in demand from across the segment wherever we are present. So I won't say the particular, we haven't seen anybody going slow now. People who have not bought product, they started buying the product. So I can make a general statement that the demand has recovered overall for us, as long as Yasho's products are concerned.
So the growth that we are mentioning, that is coming from the exports market as well. So you mentioned actually, sorry for the confusion, that there is stability in the exports demand versus you also mentioned that there is growth that we are seeing in the exports. So is it correct to understand that there is already growth that we are seeing in the exports market, or we are yet to see in a quarter or two?
No, we have already seen the growth in the export market in last quarter. And we are seeing that in this quarter also that looks to be continuing, looking at the present order.
All right. So, we are expanding capacities primarily on rubber and lubricants. So, I was given to understand that this is a quite mature market, and given that we have expanded our capacity significantly and we also have phase 2 coming in. So, what gives us confidence for reaching this 50% utilization levels in the first year itself and then go on for further capacity expansion, given that this is a market where there are already matured players. So do we have any order book or any kind of specific customer requirements that we are filling in, or how should we look at it, sir?
Well, for a new project, we already have some soft commitment from many of our customers. It's a question of new location validity. Even though you are supplying from one plant, when you go to another plant, they need to revalidate the product. So that's what has to continue now. Which already started the work. And then there are some customers who don't look at it, but they only look at the product and how it is specification-wise. It's approved and it start working. So we have two categories of customers who has a long-run process of an approval, and while some customers which is a shorter time, which is between 1 to 2 months. So right now our primary focus is to focus on 1 to 2 months and start rolling the product out, and then waiting for a long-term larger customers who could stand with us for a long time.
All right, sir. So in terms of these products, are we seeing the dumping in India continue, or is there any kind of lower dumping or any such scenario in these products?
Well, dumping is happening everywhere, so I cannot make a judgment about that, what will happen, what will not happen. Okay? But the dumping is everywhere currently, from manufacturers from Asia, particularly. And unless until there is a mass improvement in that part of the world, we expect that to remain there. And that's the reason the raw material prices are also at the bottom side.
So in terms of this new plant, what is our target domestic versus export mix vis-a-vis the current 64% exports that we have?
Well, we hope to be maintaining the same ratio, but we might have a little more demand in a local market purely because of the Make in India concept. That might help us to we know a lot of local users who are importing the goods. But otherwise, the ratio should be in the same range, between 60 to 60-40 ratio.
Okay, so lastly, in terms of China plus one, so in some of the previous Concalls, we had mentioned that other than USA, there is, or I would present it as other than USA because they have 25% anti-dumping duty on the Chinese. Is there any other location where you are witnessing this China plus one theme play out?
Well, now that everybody are aware about the supply chain risk, so people are looking at alternate geographical sourcing, provided you match the price. Okay, so yeah, they want a non-Chinese product, but that's the Chinese price. So that's the challenge. And that's what I made a comment, that there is a severe pressure on the pricing.
Okay, sir. So lastly, so you mentioned with the current capacity for the Vapi plant, there is 25 to 30% specialty and rest is commodity. So in line or continuing the question of the previous participant where, the 3350 rupees per kg is expected to be the realization. So will the new plant have more of commodity versus specialty, or is it the same mix that is going to continue? And a bit more clarity on, sir, on the realizations of the new products, or I would say the products from this plant versus the Vapi plant.
And it would, okay, your question is that how the realization looks like at the new plant. New plant is, as I earlier said, that the Vapi will produce more niche product, low value product, when you go to the high volume product, they are kind of a commodity within the specialty segment. So we are getting to that phase. There could be a little special somewhere else, but if you go to the main application, it's kind of commodity, and the volume is there. So when you move to the high volume, we are not expecting and also the pricing of the product are in the range of 300, 350 range. So that is going to be a trend. As of now, at new plant, we don't know what's going to plan after 2 years. So I cannot comment about the future. But the current status is that currently the product which has moved to Pakhajan is all are into the commodity nature, and all special products have been still going to be produced in Vapi.
Then, sir, if Vapi will have more of specialty and Pakhajan will have more of commodity, and then we are also guiding that margins will be higher from this plant. So I'm unable to connect the dots. Is there anything I'm missing?
I think we can talk this on some other time, okay? But margins are currently we are happy to maintain the margins in this difficult situation. I'm saying that margin can improve as tomorrow if there is something else happening in the market. Okay, I cannot comment what's going to happen tomorrow today here. So I don't have the clear clarity about the future, how the prices are going to move forward. What we are just saying that the product which has moved to Pakhajan has a better EBITDA margin compared to that is mainly due to the sheer capacity, volume, and then automation what we have deployed. So that is going to reduce a lot of our cost there.
Sir, just one last question, if I may.
Yeah.
Yes, sir. Despite challenging environment, you had mentioned that we have witnessed a growth in our exports volume this quarter. So could you give me just the exports part, how much growth we have witnessed in terms of volume on a QOQ basis?
Well, we have not mapped for how much, but the export has increased almost. Last quarter we grew almost by 35%. Now that 35% growth, I will say more than 20% has come from an export and 15% must be from domestic side.
So this is in terms of volume?
Yeah, I'm talking volume. I don't talk about the pricing. Because always I like to measure myself in quantity, because price can change tomorrow, whole dynamic can change. If this price would be in 2020, the top line could be different level.
Okay, sir. Thanks and all the best.
Thank you.
Thank you. We have our next question from the line of Pranav from Singular Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. My first question was on the capex at the Pakhajan plant. In the deck, you'd mentioned that the capex cost is increased by 70 crores due to automation implementation that we've done. I just want to understand if there's any operating benefits that we gain out of it, or if there's any upside to the EBITDA margin we'd guided to.
Well, not only the upside, the original capacity was 17 KT, which has improvised to 20 KT, which is the automation. So automation is indirectly help us. Number two, the kind of chemicals we are going to utilize at Pakhajan are more toxic, inflammable. So we need to have some more safety feature. And looking at certain conditions, we have decided that let's go for full automation rather than the partial automation. So the 70 crores has also transferred into the 2,500 ton additional capacity. It's not only the automation cost.
Understood. So my next question was on the utilization for the Vapi plant. Could you help me with what the current utilization level for Q4 would have been?
Well, I won't say the Q4 must be full capacity. So on an annual basis, it has crossed more than 90%, 90-92%. See, the Q4, when we say the utilization, it is always what stock you are carrying forward. You are not only what you produce, but also what you carry for stock. So when you look at the sales, don't speak about what you produce, but also what you had in stock.
Understood.
Yeah, thank you.
It's related to this. So since we're moving a substantial number, or rather volume of our products from Vapi to Pakhajan, what would the utilization post-commissioning of these products at Pakhajan, what would the utilization in the Vapi plant look like for the current year? I mean, I'm not looking for specific numbers, but just general guidance.
We are expecting to keep this momentum on. That means we should be able to utilize more than 90% of the plant capacity.
Okay, understood. And so just last one, clarification on the cost of funds that you had mentioned earlier. Could you just repeat that number?
I think cost of fund is between about 8.75% average cost.
Okay, sir. Thank you.
Thank you.
Thank you. We have our next question from the line of Naitik from White Oak Capital. Please go ahead.
Thank you, sir, for this opportunity. So, two quick questions. One was on other expenses. So, our absolute amount of other expenses reduced from about 103 crores in FY23 to 70 crores in 24. And even when we look at it as a percentage of revenue, historically it used to trend somewhere around 16-17% of revenue, but this year it's about 12%. So has something structurally changed, or have we received any one-time benefit over here?
No, I see the other expenses include about the freight cost. Freight cost is reduced compared to the previous year. FY23 to FY24, the freight cost was reduced drastically. Number two, there was a saving on a cost of power and fuel, where we did some changes in our process. So we saved some power, but also cost of the gas has come down in the last 6 months. So that also helped us to reduce the cost. And this was last, there was a less amount of repair and replacement.
Okay, so we expect this to sustain in future, or is it expected to rise back again?
As long as freight is there, freight cost is there, which I can't control, but yes, repair replacements are kept very much under control, which we are monitoring, and our team are taking care of that very well. Again, the power, we are very much confident that we'll be able to keep in check the kind of measure we have put in place. And but for gas, I cannot say that. It's we buy from government, GSPC. Right now, everything is downward, and we hope it remains that, but we can't promise that. Nobody can promise that.
Right. Got it. And even in case of depreciation, it reduced from 20 crores to 15 crores this year, absolute amount, whereas our net block is broadly at the same level.
One second, Mr. Deepak will give you the idea on that.
So most of the assets, the old assets have been utilized, and that's the reason the depreciation has come down from 20 crores to 15 odd crores.
Got it.
Yeah.
Got it. Okay. And lastly, sir, if you can help with the volume growth in the industrial segment. Overall, we have got, but if you can help with the specific segmental volume growth.
In industrial segment, we have grown by you talk about last quarter, or you talk about the overall year?
Overall year.
Okay, that's an interesting number. We've grown in industrial and we have degrowth in consumer.
Sorry? If you can.
We have grown in industrial segment, and there was a degrowth in the consumer side.
Right. If you can call out the percentage growth in industrial.
That's about 17-18% growth.
17-18%. Okay. Thank you so much, sir, and all the best.
Thank you.
Thank you. We have our next question from the line of Pradeep Rawat from Yogi Capital. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. So my first question is regarding the what is our current addressable market and some significant competitor that you can highlight?
Well, current addressable market for a new product what we are manufacturing is in the range of about $10 to $12 billion. The rubber side we are into about $4-5 billion. The specialty is into the $500 million, and so overall as a Yasho level it should be in the range of $18 to $20 million. Of that, Yasho is right now at about $80 million. So there's a vast gap between two of an addressable market and what we are doing today.
Yeah, that's great. And my other question is about, do you see any risk for our estimate of 90% utilization for FY26 in the new capacity?
FY25 or FY26?
FY26.
I don't see, as of now, the kind of commitment what we have, the kind of customers will come and are doing audit, and the soft commitment what is coming forward, we don't see a challenge there.
Okay. And my other question is, what would be the top line guidance for the upcoming facility?
Well, what we are expecting in this FY25 about 900 to 950 CR revenue, and in FY26 in the range of about 1250, 1300 CR top line.
Okay. And regarding the new product pipeline that you have stated earlier, that 4 products that you are developing, you said that its addressable market is around 5,500. So can you give me some light on it, that how much opportunity that can we capture?
I think we can capture a couple of opportunities what we have mapped from our customer. As the customer has shown interest, we should be there. Not too late, but somewhere by end of this year, because a lot of companies are global companies. If they have RFQs, their RFQ will be coming in place somewhere in end of the year, and we should start getting a business. Trial supply started, but the major RFQ only comes if we win the bids. So that's why for this year we are only talking about 45-50% utilization. First 2 quarters we don't expect too much operation, because we have to wait and watch for the final approval from our customers, and then the real business should kick in only by the somewhere in Q3, and that will start to present the plant with almost 60-70% from 20%, 25% in Q2. So that's one jump we are expecting, and then the last quarter should be we should be there.
Okay, great. And my other question is regarding our margins. I can see over the year our operating margins have improved significantly. That's quite wonderful to see. Can we expect margin to grow further in coming years?
I think we should expect, because we should, at Pakhajan, our expenses still should be under control. It's a mode of automation. Number 2, our fuel is not gas, but it's a coal. Major fuel is coal there at Pakhajan. So that should bring in a lot of saving. Thirdly, we are also implementing the kind of an alternate source of energy, which we will, once we install it, we will make announcement. So that should also save a lot of money for us. So there are a lot of efforts we have been taking at new plant. That should bring down the cost. Other expenses like freight is beyond our control, which is sometimes a significant cost for us. That we cannot control. Number of employees are much less at the Pakhajan because of, again, it's an automated plant, no manual operations. So yes, and that's the reason we have given a guidance for the better EBITDA margin as a company level. I'm not giving you at the Pakhajan level, because we are not going to give you that breakdown in the coming quarters. It will be a company level we are expecting. So when I say company level, we are doing 20, so we are doing somewhere 22, so average will come to 20, 19, 20.
Okay, understood. Thank you for that. And I have a last question for the client concentration. Can you give a number about the revenue that we generate from our top 5 clients, top 10 clients, like that?
Yeah, that's interesting. Our top 10 clients will be in the range of about 30-35% of our revenue.
Okay. And last, yes, that's all. Thank you. That's all from my side. Thank you and all the best.
Thank you.
Thank you. We have our next question from the line of Pratik Oja from Share India Securities. Please go ahead.
Hey, sir. Am I audible?
Yes.
So, sir, I just wanted to get an idea as to, since we have presence in 50+ countries, So how has different geographical markets contributed to our revenue mix, and any particular geography where we are focusing or where we see higher growth potential? Just wanted to get an idea.
Well, lubricants and rubber both are placed across the globe, so I won't say any particular geography. So certain geography like matured market will take a while for an approval, as I said earlier, and which is not a mature market but a growing market can get a little reasonably faster approval process. So, but we are covering entire wherever we can reach out, we try to go there. So if you look at it, we are present today more than 50 countries globally exporting our product, and we intend to expand that.
Okay. Fair enough, sir. Thank you.
Thank you. We have our next question from the line of Anupam Agarwal from Lucky Investment Managers. Please go ahead.
Thank you for the follow-up. Sir, my first question is, in your earlier presentation, not last presentation, but last year, the capex cost used to be about 350 crores, and now which is 470 crores. Is there apart from the 70 crores of automation and debottlenecking, anything else that I'm missing out that has led to cost overrun?
From 350, the original project was conceived at 350 crores with a 15,000 capacity.
Yes.
And we did it, made it to revised it to 17,000, so that's the cost escalation, and again from 17,000 is going to 20,000. So from 350 to 470, 120 crores, but from there we added an additional capacity of 5,000 metric tons. Understood.
Secondly, sir, on the consumer business, you gave an insight that industrial segment has grown 17-18%, and that's 85% of business, so roughly 15% of growth has come from there. So industrial consumer segment has declined by about 5-6%. On the margin front, I wanted to ask you whether that, in the previous con calls you mentioned that it is about 5-6% EBITDA business. Whether that has improved, or is there a loss in the consumer business at the moment?
There is no loss, but the margins has not improved. So that's the reason we are not focusing on that business more to grow. Because unless and until I don't see the market, there is no reason for us to, aggressively pursue that part of the business.
Understood. Thirdly, sir, on the working capital, I have to, commend you on that we've, operating cash flows have been 100 crores in the quarter for the year compared to 10-12 crores that we did last year. Any changes in the payment terms, receivable terms that has happened in the last year which has led to this?
No, only our team is quite aggressive in collecting the money. We ensure that our customer pays on time. What we implemented is that if we don't get the payment, we don't supply. Next supply will stop to the customer. So that's only change in policy that happened, and that has resulted into the better cash flow. And on the receipt side, on a purchase side, our team could be able to manage little longer credit line from a supplier, and that is also helping us.
And how will this look like when the Pakhajan plant reaches scale? I mean, how is the working capital going to be in that plant?
I think similar level. We don't expect much to go up. Maybe right now we are running at as an overall working capital number of days is about 95 to 98. Can maximum stretch to 105, not beyond that.
Okay.
That's why we don't project any additional working capital requirement.
Understood. Fair enough. That's it from my side, and thank you so much, and wish you all the best, sir.
Thank you.
Thank you. We have a last question for today from the line of Arman from Blue Sky Capital. Please go ahead.
Yeah, just a follow-up from me, for the finance cost thing. In the beginning of the year, we had a total borrowing of around 316 crore, if I am correct, that long-term plus short-term. But still our finance cost was just around 15 crore only. So first to that how is that? Because 8.75% what you have told now, but in spite having 315 crore of total borrowings, our finance cost was just 15 crore for FY24. In spite we have increased around 230 crores of borrowing. And secondly, my last question will be because of that previous participant told about, you have answered that top 10 clients have 40 to 50% of revenue. So just wanted to know, of this top 10 clients, how many of them have been with us for more than 3 years, per se? Yeah, thanks.
Number one, what we see the jump in our debt, but the major debt jump because of the new project, and all the interest paid till the 9th of April has been capitalized. It has not been booked into the P&L. So now you will see in this quarter that interest costs coming up rapidly. Number two, of customers of our major customers today, what we are having, all are more than 5 to 7 years in our relationship, except one who just came on board for last 2 years.
Okay. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, as that was the last question for today, I now hand the conference over to the management for closing comments.
Thank you very much, everyone, to be here, and I wish all the best to everyone. Thank you. Have a good day.
Thank you. On behalf of Yasho Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.